Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to Standard Chartered Money Insights. My name is Marco Iachini and I'm a cross-asset strategist for Standard Chartered Bank. On this episode of the podcast, we'll discuss the latest jobs and inflation data out of the US, how they impact emerging market dollar bonds, and then analyze recent price action within equities. Joining me today for this conversation, I'm glad to welcome Manish Jaradi and Fook, both senior investment strategists within our team. Without further ado, let's kick off today's podcast. Now, interestingly, two of the most recent important data points out of the US were quite contrasting. On the one hand, jobs growth disappointed, but on the other, this week's inflation data surprised to the upside. Manish, how does the team read these two prints and how do they impact the overall investment strategy?
Thanks, Marco. That's right. The reconstructed adage, jobs everywhere, not a soul to hire, pretty much summarizes the recent US macro data. While US job vacancies rose to their highest in 2 decades, hiring in April missed expectations by a wide margin. The data has raised concerns about emerging shortages leading to a sustained rise in inflation, which could force the Fed to tighten monetary policy sooner than the markets currently expect. We believe the concerns are overblown. While there are several explanations for the US jobs data miss, the one that stands out is the Biden unemployment benefits package, which we believe is working as a disincentive for potential employees to look for work, especially in the lower income segment. This explains the surge in average weekly earnings in this segment. Now, there is another missing driver of inflation, that is sustained wage growth. There is significant slack in the US jobs market as millions of workers stay home either until they get vaccinated or until unemployment benefits run out. While this could create a window for a few months for US inflation data to surprise on the upside, we agree with the Fed that the inflation surge is likely to be temporary as vaccinated workers eventually return to jobs, businesses boost supplies, and the base effects on prices fall away by the fourth quarter of this year. Hence, we expect the US central bank to stay accommodative for at least the next 6 to 12 months and not to react in the near term or not to react to the near term turbulence in inflation data. From a market's perspective, the longer term global reflation story remains intact, as seen through the lens of fundamental drivers such as faster pace of vaccinations and improving economic and business confidence worldwide. This improvement is also reflected in upbeat corporate earnings.
In last week's episode, we discussed our view on US Treasury yields and why the team believes that yields will be range bound between 1.5% and 1.75% with an upward bias for the remainder of the year. Now, as you just mentioned, the team seems to side with the Fed's view that inflation being transitory. Now, outside the US, whether temporary or not, inflation might have implications, particularly for emerging market US dollar bonds. Now, with regards to this asset class, what's the view from the CIO office, and are you concerned? Any concerns?
Emerging market USD government bonds have a relatively high sensitivity to US interest rate risk. That is, bond prices falling as US Treasury bond yields rise. Our baseline view remains that the 10-year Treasury yield stays range bound within 1.5 to 1.75% in the coming 6 to 12 months as global monetary conditions remain largely unchanged. But if say, for instance, US Treasury yields rise by 25 basis points, then EM USD government bond prices could fall by about 2% or so, assuming all else remains unchanged. However, the reality is that this would be at least partly offset by a narrowing of the yield premium over treasuries, and the nearly 5% yield on offer would help deliver still attractive returns over a 12-month horizon. Moreover, a structurally weak US dollar could support fund flows to emerging markets, and further, commodity price gains could also support emerging market credit quality.
Thank you, Manish. Let's move over to Fook. We saw quite a bit of volatility in equity markets this week. The VIX jumped significantly, and we also noticed ongoing weakness, particularly in the Nasdaq 100 and growth-related stocks. What do you expect going forward, and what should investors do with their equity allocations?
Yeah, thanks, Marco. You're right. I mean, it has been volatile, and with the Nasdaq, I mean, we wrote last week expecting short-term weakness in Nasdaq, and the key arguments for that was being rotation into value sectors, and also concerns about Biden's capital gains tax. And now we have further pressure as well with fears of inflation surging. So the Fed has said that they will remain accommodative, but the market is speculating that the Fed might be forced to tighten policy. So yeah, that's an additional headwind for the Nasdaq. So if you look at the breadth of Nasdaq as well, we also see that only 26% of the index is above their 10-day moving average, and this compares to the Dow Jones, where over 80% of the index is above the 10-day moving average. So the breadth in the Nasdaq 100 is significantly weaker, and we also see other technical indicators for the Nasdaq looking weaker. So for investors, we'll watch out for short-term more weakness. That's something to be watchful for. And our preference really is for value sectors, as we've written before. And we think that value sectors will outperform in the next 6 to 12 months.
Great, thank you, Hien. Now, lastly, on UK markets, which, as we've highlighted in the past as well, they have quite a bit of a value tilt. Now that the British elections are behind us and perhaps the risk of a Scottish independence referendum has somewhat diminished, what's the outlook for UK equities and the British pound?
Yeah, thanks. We like both, actually. We like UK equities and the British pound. So first on the British pound, I mean, we think it will stay strong because, as you say, the Scottish referendum risk has diminished now. And then if you look at the British pound versus the US dollar, we see good support at 1.4 and also in the 1.36 to 1.38 region. And in UK equities, we also expect it to go up. If we look at the large cap, like the FTSE 100 index, only about 20% of the revenue is generated domestically. So yes, exchange rates can have a big impact on the index. But the FTSE 100 also has a heavier exposure to value sectors, your cyclicals, and your commodity sectors. So if the rally in global energy and commodities continue, that is supportive for the FTSE 100. And also compared to other regions globally, the UK equities is cheap, and we like the value exposure there. But within UK, we do expect the FTSE 250, which is your small to mid-cap companies. So we expect the FTSE 250 index to outperform the large cap FTSE 100 index. So the FTSE 250 generates 50% of revenue domestically, so it is less impacted by the stronger British pound. And also the UK is ahead of other markets in the vaccinations, so that will help the domestic UK economy as well. But overall, for the UK equities, we do expect positive returns for both your large cap FTSE 100 and also for the small to mid caps FTSE 250.
Thank you, Hien. So it looks like quite a positive picture in the UK, especially domestically oriented companies, and also thanks to the vaccination progress. Great. Well, thanks again, Manish and Fook, for joining our conversation today. That is all for this episode of Standard Chartered Money Insights. If you'd like to learn more or read our publications, please visit our website at sc.com under Latest Market Insights. As a reminder, if you enjoyed our discussion, please rate and review us wherever you get your podcast. Thanks for joining us. Bye.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.